You're watching TVP World. We're here in Brussels to discuss a new proposal by the European Union's 6 biggest economies. They want large stock markets in the EU to be regulated not by individual countries, but by the European Union. On the EU level, perhaps here in Brussels, this with a view to trying to standardize, to make the European Union more competitive at a time where the global economy is squeezing the EU between an increasingly aggressive China, aggressive United States, and of course not being able to buy cheap energy from Russia. The last few days of high oil prices will also bring competitiveness into focus. A lot of questions about what that means exactly. We've got an expert here with us, Rebecca Christie from the Bruegel think tank. Thank you so much. You are a senior fellow at Bruegel and the host of the Sound of Economics podcast. We're grateful for you being here because these stories seem quite complicated. Hopefully you can shed some light. This proposed reform by these 6 countries, what does it mean? Why now? What's the point?
Thank you very much for having me on the show. The letter from the E6 on broadly how to improve the European Union's capital market situation and how to make it a better place to raise money, invest in the economy, and grow. That's the goal, and that's what we're trying to do. Now, you ask about supervision. Supervision is one of the biggest things that can be done at the European level to help with this goal. At the European level is a very important part because a lot of the things can only happen at the national level. So, okay, what are we talking about? We're talking about taking things that are not banks but work in finance, like stock exchanges, asset managers, clearing houses, sort of the back end of the financial system, and looking at them, supervising them at the European level in hopes of reassuring investors that there's a level playing field, that everyone is following the same rules, and that there's a quality of supervision throughout. This in turn might allow the industry to consolidate, or it might just mean that it keeps going and it's better managed. There is a proposal on the table from the European Commission from late last year in 2025 to get started on this. However, it has faced fierce opposition in the working groups. To have these big 6 countries come out and say they'd like the countries to agree on a general approach, which is so what happens is the countries have to agree, and then the European Parliament has to agree, and then they have to agree together. So this is the first step. But for the countries to get an agreement on this within 6 months, given how long and how hard this has been out there and opposed, that would be a very big step forward.
What changed?
There's a real acknowledgement that Europe has to make more of its single market. The single market is when all 27 economies work together. Without that, there's no way that Europe is going to stand up to the US and to China.
This would have an impact on the larger economies who are pushing for this, notably Germany. In the past has been quite reticent and if not fully opposing these kind of moves. Is there a potential for a shift? Is there a change in Berlin? Am I perhaps reading too much? What's your view on that?
There is a potential for a shift, but we don't really know where they're going to come down on this. We know that just before this group of 6 countries got together, the German finance ministry put out its own 10-point capital markets union plan that did not refer to supervision. So common supervision is something that the socialist finance minister, Lars Klingbeil, has supported. It's something that, again, there's a push at the Commission. It was in the Draghi report. It's something that people really think would improve confidence and efficiency in the EU single market. But there are a lot of reasons why people like their national systems. They like to protect their national regimes. If you're a country like Poland, where you are often a host country and not a home country of these financial institutions, the cross-border dynamics make it really hard to support centralization without big assurances that your needs will be taken care of.
So we have this proposal from the E6. We're still a long way away from this actually happening, I presume. Walk us through the avenues that may happen next. This is a bit crystal ball territory, you'll forgive me, but, imagine there's a shift in support. Berlin, Paris, big economies are pushing for this. Still has to go through the council. What does the future of this idea look like?
It's a good sign that these 6 countries have gotten together and that they've chosen to lead with supervision. There were other things in their letter. They talked about finishing work on the securitization package, which is a thing that has to do with how banks make their loans and manage them on their balance sheets. There were other efficiency measures in there. But just recognizing that supervision is important is a big step forward. This is something that people haven't wanted to do. Now, the trick with market supervision is that it's mostly about who's the watchdog. Like when you're talking about banking supervision, you're talking also about banking backstops. Who's going to put up money when banks fail? This is still unresolved. We have common supervision with the single supervisory mechanism for the euro area, which is based in Frankfurt, part of the ECB. We don't entirely have a crisis management and resolution framework, but it's getting there. It's moving in that direction. And there's certainly widespread acknowledgement that coming up with money is a big part of moving forward. For market supervision, it's about regulation and it's about who's looking over the financial companies' shoulders. So for the countries that host these firms, they want to have faith that a European supervisor is going to treat them all fairly, is not going to push anybody into a French model of running things, which is sometimes a concern because the European Securities and Markets Authority is based in Paris, even though it's not a French institution, it's a European institution. There are questions about the way that countries represent themselves in putting together ESMA's working management and board. Does that need to be overhauled? So all of these details would need to come forward. Again, the fact that we're talking about it is a big step, even if it means we don't have a deal yet.
Different kind of landscape, because there are national security concerns, there are supply chain concerns. How is that different?
With defense, there is a real need to just do more, buy more bullets, more radars, more missiles, more everything. And so when you're doing that, you have to decide what are you going to make yourself and what are you going to buy from other people? What are you going to team up to do? Because, for example, in the case of air defense, you could really see how defending sort of a swath of the European continent is easier than a little particular place. But also, if you're looking at manufacturing, you do want to have things be homegrown. We saw in the news that Ukraine and Romania are going to team up to build certain military equipment. And that's a situation where you could see some real synergies, where you have Ukraine, which is, of course, in a conflict very close to the EU's borders, Romania, which is an EU country, which is eligible for some EU funding, working together to make the things that they need and make themselves more independent from the global supply chain.
Same question, effectively, as I did before. How long before we start seeing that? Right? There's a lot of planning, there's a lot of investment going in now. We have SAFE, we have loans, the money is starting to be agreed. Having reported from Ukraine, there's a sense there of, what are you all waiting for? This is slow, this is drawn out. When do you imagine we see, I'm simplifying now, new factories, new production, new tanks being rolled out, more ammunition coming in, the level of defense investment, but also outcome that political leaders say we need?
I do think this agreement with Romania and Ukraine is promising and is a model that other countries could follow. For the bigger countries, they face the traditional defense acquisition questions of what are we buying, how fancy do we need to make it, and is it more important to have it fast, is it more important to have it good, or more important to have it cheap? If you try to do all three of those at the same time, you're probably not going to get what you need. So the question will be to pick a priority and then go for it. That's very hard for countries to do, but there are a lot of reasons to make a real push for it now.
Well, a lot of political reasons, as we've seen. I want to come back to our initial E6 proposal. What else might be in the pipeline that wasn't considered before, that will be considered now? As you said, to streamline the supervision, other things that actually could be done quite quickly, perhaps from Draghi. The Draghi report, of course, laying out a lot of competitiveness weaknesses in Europe, and a very popular evening reading here in Brussels. What else could we be expecting down the pipeline in the days and weeks to come?
A thing that isn't in the E6 letter, but is really important for the future of investment and for the future of capital markets, is a safe asset for Europe. Now, a safe asset is a top-rated bond that can be sold quickly. It's liquid, so there are a lot of them and you can always match sellers and buyers together. And that also can be used to price other sorts of things. Like if you have a bond, you want to know how does it compare to this safe asset at the core of the market. For the US, it's the US Treasury bond. Up until the pandemic, Europe really didn't have a clear one of these. There were a good number of top-rated borrowers, but none of them held that central place in the market. Since the Next Generation EU plan came out, the EU has really moved into this or toward this top tier of borrowers. I say toward, not quite in, because of some technical factors that haven't caught up yet. But a big thing happened. A big thing happened in April of 2021. And the fact that it went so below the radar is one measure of its great success. The EU combined all of its borrowing into one stream of selling bonds. They effectively separated the borrowing side from the spending side. So the spending side is still subject to all of the political oversight, all of the debates. What do we want to borrow together? What is worth defending our joint reputation for? Those are very, very important discussions, especially for countries inside and outside the euro area who are working with different constraints. But on the borrowing side, they're all the same bond, which means that when safe bonds are agreed, or pandemic bonds are agreed, or the 50 billion for Ukraine is agreed, or the 90 billion for Ukraine is agreed, when they go to the market, it just looks like an EU bond. That's great. That is a huge tool that Europe has. That is progress that has already happened. And to the extent that political leaders can find the will to spend more together, that tool is right there ready and waiting for them to use it.
I'll finish on another metaphor. The impression I get is we are dealing with a very, very large ship. These changes may seem incremental, they may seem slow, but the impact when the ship turns can be vast. And I think that's a lot of these discussions, which I'm sure we will have again. Thank you so much for joining us for this fascinating discussion, giving us your insights and helping us navigate the slightly choppy waters. Europe has to pick its starting 11, prioritize where its key competitiveness can come from. Thank you so much for joining us on TVP World.
Thanks for having me on the show.
And thank you all for watching. That's it from us here in Brussels. Stay tuned for more here on TVP World.